Good afternoon, everybody. Thank you for joining ITAR online webinar. Thank you for everybody joining ITAR today. And also, I want to thank our guests. So, new week, new guest. Dr. Samer Adra, our guest today. Thank you, Dr. Samer, for accepting my invitation.
Hello. Hello.
Hello, Dr. Samer.
Thanks for having me. Thank you.
Thank you. Dr. Samer joined Birmingham Business School after completing his PhD in economic at University of St. Andrew. His research is primarily focused on the interaction between stock market movements and corporate action. He examines the extent to which companies learn from the virtues in their own stock return in developing and adjusting key corporate action, such as mergers and acquisitions, M&A, and equity offerings. Summers' work has been published in reputable journals such as the Journal of Corporate Finance, the Journal of Empirical Finance, and the European Journal of Finance. Thank you, Dr. Samer, for accepting my invitation, and the floor is yours. Before that, I just want to mention that you have 45 to 1 hour for your speech, and then we'll open the floor for any question. There is two type to ask the question. Anyone can raise their hand, and we can go one by one to ask Dr. Samer, or you can type your question down in Q&A, and we'll read it to Dr. Samer. Thank you so much, and the floor is yours, Dr. Samer.
Fantastic. First of all, thank you very much for inviting me. And I want to thank Dr. Ahmed especially. And I appreciate all the hard work he's been doing in the last year or so. I guess this group has come a long way, and it's a great opportunity to present my work to you. Okay, so what I'll do is I'll share my screen, and then we will go through the PDF version of the paper or the presentation. And so I guess the screen is clear for you guys. If you can let me know in the chat. All right, excellent.
Yes, everything.
So what I'm presenting today is actually a paper, the Informational Consequences of M&As, Mergers and Acquisitions. It's a paper written with my mentor, Leonidas Barbopoulos from the University of Edinburgh. And we finished this paper almost a month ago. We've been getting feedback, from here and there, but we think it's ready to go, to be out in some conferences, probably for a submission at some point. So we welcome feedback about the topic, and hopefully you guys will enjoy it. Okay, so let me start with, let me move my face here. Yes. All right, excellent. So let me start with a conventional view of price informativeness. What do we actually learn in a corporate finance or a financial markets class? Mainly, we learn that there's this type of unidirectional relationship between the corporation and the secondary market. So you have a corporation, and it does stuff, right? It announces investment, it engages in financing, it acquires other companies, it is acquired by other companies, it adjusts its earnings, so forth and so on, and it releases the information to the secondary market. And the secondary market is just a passive receptor of this information. Okay. everything that needs to be known is known in the corporation. If you think in terms of a project, for example, usually the corporation, the standard rule is that a project must have a positive net present value, and the company knows it's a net present value project, and because it knows it is a net present value project, a positive net present value project, it announces it to the secondary market, and the secondary market will react. Okay, so there's nothing that the company can learn from the secondary market. It's more that it's more likely to be the case that the secondary market is reacting to what the corporation is doing. And this arrow here, or this channel, gets strong or weak. Okay, so in a Eugene Fama world, in an efficient market world, this channel is very strong. Okay, the secondary market reacts and properly values the information that is available and trades based on it. And if you have a good project here, your stock price will be up here. Okay, because people will know it's a good project, they will increase their demand and supply, price goes up. And then there's behavioral finance. The field of behavioral finance tells you this channel can be sort of weak at some points. You can have behavioral biases that affect decision making in the market. The scope of the information may not be clear enough for investors in the market. They might have biases. They might have behavioral tics. They might have some liquidity problems, mainly, that prevents the information that is developed here from being transmitted straight towards the market here. Okay, and then you have works like Robert Shiller, for example, who says, well, this here is too volatile given the information released here. So the human errors in decision making and the biases and so forth, according to Shiller and Thaler and people like that, will lead the secondary market to overreact, underreact, to have excess volatility over a long period. And that's fine. However, there's another approach, which is, let me make it clearer for you. I will make it smaller. And this is called a strange loop approach to price informativeness. A strange loop is a term that is borrowed from a cognitive scientist called Douglas Hofstadter. It appeared in many places before, but it mainly reached its peak, or it mainly reached its fame in a book that he wrote about Austrian logician Kurt Gödel. And the key point is that complex systems, and the market is an example of a complex system, tend to have like these strange loops, these things that go back and forth in the system. So the same way the corporation releases information to the market, well, the market can also send information to the corporation. You can think about it in the most basic way. Let's say you're a corporation and you announce a project and you think it's a positive net present value project. That's what you think. And the market disagrees. So we reach a point where the market is disagreeing with the corporation's assessment of the project. And the corporation, based on the market reaction, may end up withdrawing the project because the market gives a verdict and the corporation thinks that the verdict of the market is accurate because the market is a system of dispersed information. If we use the term of Hayek, the market has an epistemic function. It assembles information from many people, from many traders, and these traders sometimes reach a verdict, reach a conclusion that is far richer informationally than what happens within the walls of the corporation. And the market can tell the corporation, no, this is a bad project, do not continue with this project, do not proceed with it. And because it does not proceed with it, it ends up canceling it. So we have a two-way thing happening here. We have a strange loop. This strange loop between markets and entities doesn't only hold for corporations. Let me give you a basic example. Elections, right? US elections or Brexit or some other events that happened. The betting markets were more accurate than the pollsters in predicting these events. They did not fully predict them, but they gave higher probabilities to, let's say, Brexit or the election of Donald Trump than what the pollsters were doing. So these betting systems seem to provide some information to the people inside these entities, which is whether it's a corporation, whether it's a government. And actually, because speaking of government, one US entity called DARPA, which is a US security agency or doing some research on security, was at some point contemplating the idea of having a betting market on terrorist attacks. So where is the next terrorist attack going to take place? And they thought, well, we can learn from the market, from these betting markets, whether it's financial market or betting market, what is going to happen or what is likely to happen, and adjust to these events. Great. So now that we have established that we have this two-way loop going on, our key, what do we do in this paper? Well, what we're saying in this paper is that the corporation can engage in some activities that make this relationship stronger or weaker. So you can adjust your structure as a company to make yourself more exposed to the flow of information coming from the secondary market. Okay. By doing that, you can enrich your information environment. So a company can engage in specific actions that enhance the flow of information coming to the company from the secondary markets. And actually, while people like to present models of financial markets and show equations and differential equations and dynamic systems, I think the best presentation of financial markets is a painting. And this is a famous painting called Drawing Hands by M.C. Escher, who's a Dutch painter. And what it says is the following. Look, you have a hand that is painting, but the hand that is painting is being painted. So you have a corporation that is releasing information, but the information that is released is shaping the company. And you have this entanglement between the company and information in a way that is far, 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 far richer than what a regular textbook in finance would say. So what do we do now after all these all this presentation and all these paintings? Okay, well, what do we do in this paper? Well, we're evaluating the role of mergers and acquisitions in shaping these relationships, and we're saying the following: M&As have informational consequences beyond their immediate wealth effects. So mergers and acquisitions, what I'm saying, mergers and acquisitions can make this relationship stronger or weaker. And we find that acquirers receiving a positive market reaction to their M&A announcements experience an increase in the richness of their information environment. So when you engage in a merger and the merger ends up being a wealth creating merger, the wealth creation is nice, okay? We want wealth creation, but a byproduct of this wealth creation is the strengthening of the informational link between your corporation and the market. So acquirers who actually engage in value enhancing mergers attract more informed trading. So wealth creating M&As attract information driven traders, and these traders start engaging in more transactions related to the company, and the company can monitor its stock price and learn more about its business activities and its business prospects from these traders after proceeding with a positive, or after announcing a positive value creating M&A. Value creating M&As also attract more analysts later. So analysts shift from companies that announce poor mergers to companies that announce good mergers. We also notice that the investment activity of companies that announce wealth creating M&As become more sensitive to their stock price or to their stock market valuation. So it means that the stock market starts taking a more guiding role in the performance and in shaping the investments of the corporations that announce positive market return M&A or M&As with positive market returns than the case of companies that announce M&As with a negative market reaction. So this means what? If you announce a value creating merger, you enrich your information environment. But the opposite also, a corollary to this statement is that if you announce a wealth destroying merger, what will happen is not only you will lose wealth in the short term, but you will also suffer from informational decay in the near future. Okay, so mergers have this ability to shape your informational environment. Where does this theory come from? We did not develop this theory. This discussion is available in a or a hint of this discussion is available in a paper by James Dow and others in the Journal of European Economic Association in 2017. And their theoretical model, they have a theoretical model. It's not an empirical paper, but it's a very rich theoretical model. And they say the following: informed trading in a company share increases with the ex-ante profitability of its investments. So high expected gains make it more likely that the firm will proceed with the investment. And the value of the firm's shares become more sensitive to the information collected by equity investors. So if investors know that a project is profitable, they become sure to some extent that the company will not cancel this project. And because they are sure that the company will not cancel this project, what will happen is that they will intensify their trading and their information search and their engagement with the company. They start buying and selling and waiting for the announcements and reacting to the announcement and assessing the announcement. But when companies have ex-ante losses, not ex-ante profitability, what will happen is informed traders will shy away from the company because they would say, okay, why should I put so much effort in investigating these companies' projects if I know that these projects will be canceled? So the equity investors' propensity to collect relevant information about the firm's business prospect increases when they know that the project is profitable. Okay. That's their key theoretical prediction in their mathematical model right there. So why does that relate to mergers and acquisitions? Well, M&As are a perfect laboratory to study this relationship. Why? Because we know that M&As are informationally challenging. An M&A or a merger or an acquisition, a takeover, is not an easy task. It's informationally intensive. It requires a lot of research, and it leads to significant valuation and stock performance. And there is considerable evidence suggesting that the completion of M&As is, to a large extent, conditional on the initial feedback provided by the equity market. So there's a famous paper provided by Luo, 2005, in the Journal of Finance, saying that mergers that receive a negative market reaction are more likely to be cancelled. Okay, especially in sectors that are informationally intensive, let's say the high-tech sector. So M&As provide the perfect setup to test what James Dow and others said. And actually, although their paper is actually theoretical, okay, they left like a sentence there, and what we did is we took this sentence and we built an entire paper around it, or built the entire empirical investigation about it. What Dow et al. Say the following: the price informativeness of the acquirer stock after the announcement of the acquisition will be higher if the market reaction to the announcement is more positive. That's a very specific empirical prediction that they made, and this is what we are testing. Okay, no one has tested it so far, so we're trying to, as empiricists, we're trying to build our work on a clear theoretical model that explicitly provides a prediction. So we constructed the mergers and acquisitions sample, which follows the usual restrictions provided in the mergers and acquisitions literature. So mainly we looked for friendly acquisitions because hostile acquisitions might involve regulators and might involve some defense tactics from the target, and some nasty stuff going back and forth. So we excluded those, and this is something we've done in previous papers. They are public companies, these are acquisitions announced by public companies between 1990 and 2016. We made sure that the target is public, private, or subsidiary. The minimum deal value is $1 million because we don't want to work with very small deals that might bias the sample. We made sure that the payment method in the deal was actually reported. We ensured that the acquirer owns less than 10% of the target before the merger and aims to control the majority of the target after the merger. We excluded restructurings, liquidations, leverage buyouts. These kind of complicated stuff that might differ or might bias the results one way or another. And of course, we excluded the government sector because it's not driven by market considerations whatsoever. And more importantly, we wanted to make sure that the acquirer's stock price is reported in CRISP, in the CRISP database, mainly because we use these stock prices to calculate various measures of price informativeness. Okay, so this is the brief description of the sample, and nothing off the charts here compared to the previous papers in the literature. So our sample is more or less close to what we've used in previous papers of our own or previous papers by other people covering the same period. Mainly, you can notice that most of the targets are private, which is something we know. We know that there's mixed payments that are mostly used, and there's like almost 6% of the deals are withdrawn. Some papers report 4%, some papers report 8%, so we're somewhere there in the middle. So there's nothing fishy about the sample. We made sure it's clean, and it you can find also the usual cyclical behavior of the M&A activity. It peaks before recessions, during recessions it falls down. You can see, for example, it peaked in 2007 and then it fell in 2009, then it started peaking again. When you look at the dollar values, this will make more sense because the cyclical behavior is more evident. Yeah, nothing more on the time distribution of the sample. Okay, so how do we quantify informativeness? How do we measure information in these type of things? We use multiple measures, but our most straightforward measure is the measure developed by Richard Roll in his presidential address to the American Finance Association in 1988. And what Richard Roll said, well, if you take the excess return on a stock and you regress them on an intercept and on the market excess returns and on the returns of the sector, you get an R squared. And the part of the variation that is not explained that is not explained by these two factors is actually attributed to informed trading. So informed trading is usually the trading that influences the stock returns beyond their correlation with the market returns or with their industry. And so the industry, the sector is the FAMA French sector, and the market return is the return of the market index reported on Kenneth French's website. Okay, and then what Richard Roll does is he standardized this measure by taking the natural logarithm and then taking 1 minus R squared and dividing it by R squared, and he calls it non-synchronicity. So mainly, the lower the R squared, the higher this variable, the more informed trading is assumed to be taking place. So what we do is, for each acquirer, we estimate this measure the year before the acquisition and the year after the acquisition. Okay, that's our key dependent variable in the sample. So there are lots of equations in the paper, but to make life easier for everyone, our estimations revolve around one equation. If you look at it from from a presentation point of view, we have the post-announcement informed trading. Okay, no, I cannot highlight this one properly. Doesn't matter. I'll use this other one. So we have the post-announcement informed trading, okay, which is our dependent variable, and our key explanatory variable is CAR, which is the announcement period cumulative abnormal return. So CAR is the market reaction to the deal. And if what Dow et al. Said in their paper holds empirically, we would expect alpha 2 here to be positive. Okay, we would expect alpha 2 to be positive. It means that higher CAR or higher announcement period returns should predict, okay, higher post-announcement informed trading. Okay, this is the first estimation that we do in the paper. And this is what we do. Okay, and this is what we find. So if we put post info, which is our dependent variable here, in the first regression, we just include controlled for CAR and for the pre-acquisition announcement. Okay, and we find CAR to be a positive, significant predictor of post-acquisition announcements. So the empirical prediction that they have is more or less correct. Positive market reaction predicts higher post-announcement informed trading. What we did in model 2 here is to exclude multiple bids. So to make sure that we limited our analysis to to companies that announce only one merger per year, to make sure that, well, if you announce two mergers, one is positive, one is negative, well, you know, which one is more likely to influence informed trading? Is our result biased because one merger is more positive than the other, or more negative while the other is positive, so forth and so on? So we excluded them, which reduces the sample to 5,623 deals, and we still find the coefficient to be there and positively significant. And these regressions we controlled for various other factors, but I did not put them in this table. So we control for the size of the deal, we control for the relative size, you know, the size of the target relative to the acquirer. We control for the payment method. Are they paying in cash? Are they paying in stock? Are they paying in a mix of cash or stock? Is the target private? Is the target public? Is it a subsidiary company? You know, the toehold, how much did they own before the acquisition? Is it are the acquirer and the target in the same industry or in different industries? All of these, we threw them there, we still get the same results. What we did here is we tried to dig deeper into this, and we said the following. Okay, these effects should hold more robustly for companies that had lower pre-announcement informed trading. So if a company has high pre-announcement informed trading, if a company, let's say Apple, is followed by, you know, thousands of analysts, is followed by millions of traders, a bad deal is less likely to hurt Apple in terms of price informativeness than the case of a company that already had a lower price informativeness. So if I have low informed trading to start with, so barely a few people are, a few interested traders are engaging with me in the market, and I announce a bad deal, these traders will move somewhere else. Okay, so what we're predicting is that these effects that we showed in models 1 and 2 are actually more pronounced for companies that have a poor information environment. But companies that have a richer information environment can still announce bad mergers without necessarily, you know, experiencing negative market reactions. And this is what we found. So we found this relationship here to be moderated by the level of pre-announcement informed trading. So you can think about it in the following way. The impact is negative. So it means the lower your pre-announcement informed trading, the bigger the effect of a positive CAR on your subsequent informed trading. So if you had the low informed trading and you announce a value creating acquisition, an acquisition that the market judged to be value creating, you're more likely to experience significantly more gains in informed trading in the future than a company that already have high informed trading. And this is a very nice result, because it mainly says a good merger offers a company with a poor information environment an opportunity to substantially improve its information environment. So the more we reduce pre-info, the bigger the sum of these two, because this is negative. And if this goes negative, you'll have a positive effect here, and you have to add it to this thing here, and you will get a bigger effect in absolute terms. We excluded multiple bids, and we found the same result. Okay. What we did here is simply a form of propensity score matching. So instead of running regressions, we said, okay, let's match companies. Let's take companies that got positive market reactions and companies that could have, you know, could have reached some kind of a positive market reaction, but didn't. And these two companies would be more or less similar in all characteristics. So we estimated a propensity score model, the likelihood of receiving a positive market reaction. And for those that received a positive market reaction, we matched them with companies that received a negative market reaction, but otherwise they have the same characteristics. And on this subsample, we estimated our treatment effects. So we matched 2 deals, 2 untreated deals for each treated one. We made sure that the distance between them does not exceed 0.01 standard deviation. And we still found a positive and significant treatment effect. Okay, these are Rosenbaum values. I'm happy to discuss them later on if you're interested. But mainly, someone might say, well, did you control for this? Did you control for that? We cannot control for everything because, you know, we can get the data, but it will keep reducing our sample. So but to escape this kind of criticism, the best way is to test the sensitivity of your results. And the sensitivity goes as follows here. A missing variable, whatever this variable is, should increase the relative odds of one of 2 matched deals being a positive value creating deal by more than 80% in order to invalidate our conclusions. So a missing variable should influence the relative odds in our matching exercise by more than 80%. To make the treatment effect go the other way. And we think this is robust. I mean, in the accounting and finance literature, usually values between 1.5, 1.6 are considered, you know, highly robust, highly insensitive. So 1.8 or 1.9, you know, are usually quite good. I mean, of course, in clinical experiments, when you're dealing with, let's say, smokers, non-smokers, that you can like, when you're testing in medicine and you assign something randomly, of course, the gamma values would be close to 6, but we're not experimental economists. So for social science, this is perfect for us, at least. We're happy with it. We're comfortable with it. Then, you know, someone might say, well, you used one measure of informed trading, which is price non-synchronicity developed by Roll. So what we did is we used other measures. We used PIN, which is a probability of informed trading. This is a microstructure-based measure based on trading data. We have this variable, I think the last observation is in 2010. We may more or less find the same pattern that is in price non-synchronicity. So whether we use probability of informed trading or price non-synchronicity, we get the same set of relationships. And then there's this new measure called MIA, multi-market information asymmetry, developed by, I think, Travis Johnson in management science. This measure quantifies informed trading using dynamics between the options and the stock market. So the key underlying assumption there is if there's informed trading, there should be heavy trading in either the option market relative to the stock market or in the stock market relative to the options market. So the bigger the gap in trading between options and stocks, the bigger the informed trading. And this is how he constructs the measure. Again, in the paper, if it gets published, hopefully, I wish, maybe, hopefully. We discussed this measure clearly, but it's you know, there are too many equations and I omitted them from this presentation. Also in this case here, whether we use post-MIA, so post-announcement, and there's a strong moderating factor again. So the same set of qualitative relationship that you would expect are there. So higher CAR predicts higher post-announcement informed trading, and this relationship weakens with higher pre-announcement trading and is strengthened by lower pre-announcement informed trading. Analysts. So instead of looking at measures from stock markets, why not look at analyst growth? Let's look at the humans who actually follow companies. We looked at analyst growth, not the level of analysts, because it's unfair to say, well, you know, Apple has like, you know, thousands of analysts following it, and, you know, some startup company somewhere that, or a company that went through an IPO a couple of years ago has, you know, 50 analysts. So we can't put lags there, but we used analyst growth as a dependent variable. And we've run the regressions on analyst growth. So this is the growth in analyst after the acquisition, okay, on all the sample and after excluding multiple bids. And we still find that CAR is a significantly positive predictor. Think about it this way. If your CAR is 10%, you're likely to experience up to 5% increase in analyst following in the year that follows the acquisition. Okay. Last thing that we've done, which is quite nice. Someone might say, okay, so what? So who cares? Okay, so these people are following the company. The more traders are trading. Why would the company benefit? Again, how would that help the company in any way, shape, or form? And our main prediction is that this increase in informed trading will help the company balance its investments in the future. Okay, this increase in informed trading will help the company balance its investments in the future, calibrate its investments to the market's reaction. This means what? This means that the market valuation, let's call it Tobins Queue. Now let's go back to the pencil. Means Tobins Queue here should be more likely to affect investments later, because if there's a lot of information there, the investment should become more sensitive to this information. So what we did is we looked, okay, we have the valuation the year after the acquisition, and we have the investment 2 years after the acquisition. And if what these guys are saying, well, a higher CAR should mean that the sensitivity of the investments to the Tobins Queue or to the market valuation should be stronger for companies that experience positive market reaction to their mergers. So mainly, our main prediction is that this alpha 3 here, okay, should be positive, okay, and significant, because a higher CAR should make the company's investment 2 years after the acquisition more sensitive to its market valuation 1 year after the acquisition. The lead lag relationship between Tobins Queue and investments, which is widely cited in the literature, should be stronger after the company's announcement of a value creating acquisition. And this is what we find. So we use 2 proxies. We used investment, which is investment over total assets, and we use asset growth. So these are 2 proxies used in a paper and review of financial studies by Chen et al. It's a very famous paper. So we followed what they did. And you can see here, let's go back to the highlight. You can see here, these effects are stronger. So more or less, a company becomes almost 6%, up to 6%, because this coefficient is close to 1. So let's do some rounding here. Up to 6% more sensitive to its market valuation in terms of investment for every 1% increase in CAR. So yeah, so we think this relationship is strong and robust, and we also controlled for various other factors. Okay, but remember, if the CAR is negative, this relationship will weaken. The market will stop trading in the company shares, and the company will become less responsive in its investment decisions to the feedback provided by the market, to book value estimate measure that is available in the market. Okay, so this will lead to informational decay. A good merger can lead to your informational enrichment, A bad merger can lead to your informational decay. And that's the key message from our paper. So I think I'm done. So thank you very much for this. And let me stop sharing the screen so we can have some discussion if you're interested in the topic. Thank you.
Thank you so much, Dr. Samer, for your informative presentation. I really enjoy it. Before we start, the floor for any questions. Again, anyone have any question, you can raise your hand or you can write your question in the Q&A. Let me start, if you allow me, Dr. Samer. I'm really interesting when you talk about your paper. However, I didn't see any theories in your paper. Also, in your analysis, I don't know if you solved the problem of endogeneity and causality. And also, which country do you said? What's in your sample? Is it UK?
Yes. No, US. These are domestic US mergers. So for the
and what is the observation?
7,100 something deals.
Yeah.
For the endogeneity, so let's deal with the endogeneity point of view. First of all, the key aspect of the major strength of this paper is that we have a clear sequence of events. So when you have clear sequence of events of something happening in, let's say, period t minus 1, and then something later happening at period t, okay, these two events are not coinciding at the same point, at the same time. So the usual practice of, well, let's look for a restriction and then let's look for an instrument. We escaped it by the fact of arranging these observations as a sequence of events. And so you cannot have the let's say, post-announcement informed trading before the announcement to affect, let's say, the market reaction. So this is, yeah, we try to escape endogeneity or escape, let's say, going into the deep hole of choose this instrument and choose that instrument. But also another way we escaped it is through testing the sensitivity of our results and relying on a matching analysis. So the matching analysis helped us reduce the bias due to observable factors, at least observable ones.
Did you try to check, any of other, 2 SLS, 3 SLS, fixed effects maybe, or, random C? And,
yes, we used fixed effects, company specific fixed effects, industry specific fixed effects. Yeah,
and
these
result,
yeah,
reflect the same. So
so even in the tables, I think the tables, there's like a row in those tables saying like here effects, and we put yes, or industry effect and we put yes. So there's no effect in terms of something driving the results from outside. For the theory part, is very interesting. So the theory part mainly comes from the model presented by Dow. Which is a fully theoretical model. But if you want to go deeper into the theory aspects, which we cover more in the paper, because the presentation will, yeah, we have limited time for it. It goes back to Hayek, even the famous paper by Hayek, The Use of Knowledge in Society, in I think 1944 or 1945. And it extends to other aspects ranging from the work done by Durnev, the work done by James Dow himself, and earlier work. Let's say, for example, there's the famous Dow and Gorton paper that mentions, okay, how do these market investors come up with new information? And their key explanation in their original model, 1998, I think, was serendipity. What is serendipity? It means if you spend a lot of time researching something, you know, looking for something, you will end up finding something else.
Yeah, sure,
Okay.
sure. Yeah.
And you know, there's probably, if you try to write a paper on, let's say, corporate boards, right? And as you do it, you come up with something different, and you're like, okay, that's more interesting than when I started looking for. So yeah, so we don't know that something is valuable until we find it. And there's like there's a mathematical theory apparently around this.
Yes.
Yes.
We have a question from Francis. Yeah, Francis, if
Yeah.
you don't mind. Yes, okay, go ahead, please.
Okay. Yeah. Thank you so much. Thanks, Doctor. Thank you so much for the presentation. I think it is a very detailed one.
Thank you.
Yeah, I want to clarify this issue for me. I mean, one of the tables, I observed some numbers there. The one that you have the pin and then the
PIN, probability of informed trading. Let me share my screen if you want.
I share the screen. Yeah, okay.
Okay, I'll share my screen to make life easier. Is it the one with PIN? Let's go with this one. Yes.
Yeah, so the N, you see the N there, I think the sample number.
Yeah.
So here you are saying that all of them, you have 4,684, and then excluding the base. I was wondering why.
Yeah, we mixed them. This one should be before the other one. That's an excellent observation. Yeah.
Okay. Yeah.
That's perfect. Yes. Yeah. So yeah, just to be clear, guys, this one should be here, and this one should be here.
Okay.
So
yeah.
After excluding multiple bids, we should have less observations. Yeah.
Less observations. Okay.
Yeah.
Okay. That was what I observed. So I thought it's wise to inform you so that you do the correction.
No problem. Thank you very much. Thank you.
Okay.
Thank you, Francis.
Yeah, thank you, Doc.
Thank you, Francis.
Thank you, Doc.
Should I stop sharing or what? Yeah, let me just, I'll bring back my face here. Yes. Yeah.
Yeah. Also, Dr. Amjad asked Zakallah for the wonderful session. And also he said, just want to know, author mentioned about one special paper that guide for the research. Can we go and do this research for developing country like India?
Yeah, the main advantage of being able to do this research on the US market is the availability of CRISP, which is like the database that offers a lot of daily observations and weekly observations for stock returns for a large number of deals. Now, for India, if you use SDC to get mergers and acquisitions data, that will be fine. Yes, it would work. But the question is whether there's a database for daily stock observations like CRISP for India. That's something I'm not aware of. I'm not familiar with. The paper I'm referring to is Dow and Gorton. Dow et al. 2017, Journal of the European Economic Association. So it's Dow et al. 2017, Journal of the European Economic Association. So if you look up this paper, you can on Google Scholar or any other search engine. So Dow et al. 2017, European Association. Let me just mention the title because you might be interested in the title of the paper. It's called Incentives for Information Production in Markets Where Prices Affect Real Investments.
If you don't mind, Doctor, if you can, copy it.
I'll send it in the chat.
Yes, it will be great. Please.
Yeah, fantastic. Okay, so that's the title. If you just Google this title, things will be easier.
All right. Incentive for information production in market where price affect real investment from
Yes.
Dr. All right. So let me, please, Doctor, if you don't mind, the same chat, there is two. So change it to two panelists and attendees, so they can see it.
So I sent it to, okay, so I should put, okay, all panelists and attendees. Okay,
Yes.
here's what
Yes.
I'll do. And then
right.
I'll paste it again. Okay, fantastic.
Now they can, yeah, now they can see.
Yes, great.
All right. Abdul Majid say thank you for the session. Amjad, thank you. And
thank you. Thank you for attending. I know these are like busy times for everyone who's in like, you know, academia and research. So dedicating an hour of your time, that's splendid.
There is a question from Amini. Please unmute your mic, please. Yes. Yes.
Hi.
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 It's Iman. So,
Iman.
Hi, Iman,
first of all, thank you for this very interesting presentation. I really wish you good luck for your publication. And I actually have one question. Could this, well, it's not about changing the research question, but you mentioned that acquisitions, especially successful acquisitions, attract more analysts. So could this be done on other kind of investments, corporate investments, or could you just please explain why mergers and acquisitions should be the best case to study?
Yes. Yes. So of course it can be done for all types of investments that the company engages in. The key question is we needed to find specific events that shape the company's future. So mergers and acquisitions are good events because of various reasons. One, they shift a lot of wealth. So these are one of the most consequential investments that affect the company's future. There's a paper, for example, called Wealth Destruction on a Massive Scale about mergers. So mergers and acquisitions can destroy billions and billions and billions of dollars if they are not properly executed. And they cause a lot of headaches for companies. And at their peaks, you know, mergers happen in waves. So at the peak of a merger wave, mergers can be up to 15% of the GDP. So if you have the US GDP, which is around 20 trillion, okay, we're talking about, you know, trillions of dollars, $3 trillion exchanging hands, you know, just in the form of mergers. So mergers are not by any means the only events that shape the distribution of analysts. However, in terms of their scale, and if you want to test the prediction that Dow et al. Give, these are your first venue to look at.
Okay, thank you.
Thank you.
Thank you, Iman. Any other questions? Thank you, Dr. Samer, for today's webinar, and also I want to thank all the audience in Zoom and also in YouTube for watching and joining ITAR webinar. I really wish you the best of luck, and I hope this paper will publish soon in top rank journal. If you have any last words, Dr. Samer.
First of all, I want to thank you, Dr. Ahmed, And I want to thank all the attendees and all the people who are following the ITAR group and participating in its activities, especially in this period where everyone is involved in teaching and very little emphasis is done on research, especially for people who are attempting to raise their research profile and do more high quality stuff. So I think you're offering a good service in a troubled period. So I want to thank everyone who interacted with us and who attended this and who asked us questions. And I wish you all the best in what you're doing.
Thank you so much, Dr. Samer, and hope this webinar, it won't be the last one. It will be the first of another one, inshallah, soon.
Hopefully,
maybe you can
in the future.
provide workshop. Yeah.
Yes.
Yeah. Thank you so much.
Thank you.
Next week, thank you so much. Next week, next Thursday will be another webinar with Dr. Osama Abdul Latif from Qatar University on the paper about matters that matter in the key audit matters, evidence from MENA countries. I will announce the registration for this webinar in all ITAR accounts that I already write it down in the chat. You can just follow any or all the accounts, and you can register in the webinar. Also, after you leave this webinar, there will be a small survey, just 3 questions. If you don't mind, fill it before after you leave the webinar. Thank you so much, and hope to see you next week. Thank you, Dr. Samer. See ya.
Thank you.
Salam.
Bye. Bye-bye.